Good morning, Honorable President. I am Dr.V.Deepha from the Department of Business Administration, PG. Today we are going to discuss about funding under merger and acquisition and restructuring. Under funding, we are going to discuss funding of merger and acquisition, financing techniques, various sources of financing. So, funding is the main thing for starting a business. Without funding, we should not run the business successfully. So it is the main sources. So under this overview of merging acquisition financing techniques, first cash. So it is the simplest method using existing reserves or asset stock exchange shares leading to equity dilution valuation dependent. Debt, loans and bonds, leverage asset but or risker. Hybrid, it is a combination of convertible bonds and preferred stock for flexibility. Second, cash financing. Under that cash financing, utilizing cash reserves, liquidity asset. Utilizing cash reserves, directly deploy existing funds from company balance sheet. So if you want to know the company will earn a profit or loss, we can verify the 3-year balance sheet of the companies. So we can analyze if the company is going good or bad. Next, a liquidity asset. Convert non-core asset into the cash for acquisition purpose. Example, Berkshire Hathaway in 37.2B acquisition for precious cast pots in 2016 used cash reserves. Next one, stock financing. So you can see the diagram how it will be increasing the stock. Stock financing involves issuing a new shares to the target company shareholders. So they are issuing the new shares for the target companies. This method dilutes existing equity, market accuracy, valuation critical for the fair exchange share value. Fluctuations can impact deal terms significantly. So there is a fluctuation between the shares. Sometimes it will be increase or decrease. Next, debt financing. Under the debt, you have bank loans, high yielding bonds, mezzanine financing, leverage buyouts. Under bank loans, it's a traditional financing from financial institutions. So whenever you started a business, you're getting loan from the banks. You're approaching the loan from the banks. Then debt instruments with higher risk and return under the high yield bonds. Next, subordinate debt with equity features. Acquisition heavily financed by debt leverage cost. Next, alternative financing sources. What are the sources you have for the alternative to get the funding for your organization? Venture capital, private equity firms, services wealth funds. So venture capital, you focus on the tech-oriented merger and acquisition deals. Private direct investment in merger and acquisition transaction. State-owned investment funds for the global merger and acquisition. Next, we are going to see about government funding and incentives. So the government is providing more funding to the organization sector depend upon their income. So financial aid to support strategic industries. So they are ready to support financial through the strategic industries targeting organization. So many subsidies is provided by the organization, the agriculture sector. In so many sectors, they are providing the subsidies. So they are providing a time to pay that amount fund. Then tax initiatives under reduction or exemption to encourage investment. So this tax incentives encourage the shareholders or the company holders to pay the amount investment or invest the money in the organization through the shares or some other values. So they're giving the reduction or the exemptions. Third one, regional grants. So it is specified for the economic development in these specific areas. So in the incentives, the government will provide so many sectors to develop the small sector, small scale sector, medium scale and large scale sector. They provide in the example government support for semiconductor or industries merger through incentives drives growth. So government will provide more incentive sectors. The people will be utilized to develop your sector. Thank you.